Joining us now from our Washington newsroom is Mark Zandi, chief economist at Moody's economy.com. And from St. Petersburg, Florida, is Scott Brown, chief economist at Raymond James. Gentlemen, thanks for joining us. Let me ask you, and Mark, I'll just start out with you. Yesterday, I was hearing from an employer who said, look, this is going to be a jobless recovery because a lot of us had cut half of the jobs that we had and found that we can do the same thing we were doing before. Is that a concern in every recession?
Yeah, certainly coming out of the last two recessions, we've experienced jobless recoveries, and I think certainly this will be jobless for the next year, 18 months. There is some evidence that businesses, at least some businesses, cut too much, cut into bone, and once businesses feel more confident, they'll begin to hire more aggressively. But I think we're a good, solid year, again, 18 months away from that.
So, Scott, what do we need to see? What kind of catalyst do we need to see to increase hiring? Does it have to be some sort of innovation in the economy? Do employers have to receive some kind of encouragement, gain confidence? What has to happen?
Well, you need to see a return of confidence, and I think we're well on our way there. But one of the key aspects in this recovery is going to be the continued tightness in credit, particularly for small businesses. Credit is still pretty tight out there, so it's going to be very hard for those small businesses to grow and expand and hire new workers. So we don't really expect a sharp V-shaped bottom. Those financial constraints are really going to be a serious headwind for the recovery.
Mark and Scott, I want to throw this out to you. On our coming back from break, we had a soundbite from Ken Langone. He's a co-founder of Home Depot. He said if we did in business what the government is doing about saying it's getting better, we'd all go to jail for manipulation or fraud. It's not getting better, and it shouldn't get better. Mark, address this. I mean, are things really, really getting better, or is the government kind of selling us a bill of goods here?
No, it's definitely getting better. I mean, just think back 12 months ago. I mean, we were panicked. Stock prices were falling. House prices were caving. We were losing 700,000 jobs per month at the beginning of the year. The recession is over in the sense that the value of what we produce, GDP, is going to rise. And we're going to see that for the third quarter, the just ended third quarter. It's going to rise about 3% after inflation. So we still have a lot of work to do. This is not a good economy. The recovery is very tentative, but in no way are we where we were 12 months ago. We've made a lot of progress.
Scott, you agree we've made a lot of progress here?
Well, I think we have. If you look at what the Federal Reserve has said, what the Obama administration has said, they've been perfectly consistent. This is not going to be a quick turnaround. We expect to see a very gradual recovery with continued weakness in the labor market. And I think things are pretty much progressing as planned. The recovery is still on track at this point.
Do we see then, Mark, we hear that we've lost, more than 7 million jobs, the most since the Great Depression, but we're at 9.8%, and during the 81-82 recession, we got to almost 11%. Does it get that bad this time?
Yeah, I mean, I think the other thing to realize is that what economists call the natural rate of unemployment, the underlying rate of unemployment consistent with full employment, was a lot higher back in the early 1980s. It was probably 6.5%. It's much lower now. So the 10% unemployment rate today is at least as bad as the almost 11% unemployment rate we got back in the early 1980s. And moreover, the unemployment rate doesn't do justice to what's going on in the labor market. All the underemployed people working part-time because they can't get a full-time job, and people are working, but their hours have been cut back, and people are working and get their wages cut back. So this job market is incredibly difficult, and as difficult as it has been since the Great Depression.
I don't want to open up a can of worms here, but we had Ned Phelps on the other day from Columbia. He thinks the natural unemployment rate is going to be more like 7.5%. Why do you disagree?
Can of worms, yes. That's a matter of endless debate. I don't want to argue too strongly. I mean, let me say it this way. I think before this recession, the full unemployment rate was a little less than 5%. I think it's approaching 5.5% now. I think by this time next year, it might be closer to 6%. 7%, I think, sounds pessimistic. Possible, but I think pessimistic.
Scott, where do you weigh on this? I mean, where do you see unemployment rate? Because I have heard, folks saying that it's still going to be double-digit easily next year.
Well, we'll get some support from the fiscal stimulus. There'll be some jobs created there. You've got the census coming up in the first part of next year, and the Census Bureau will have up to, I think, over 700,000 full and part-time workers at the peak. So that'll help. Those are all temporary jobs, of course. But, you know, at this point, we need to see GDP growth well above 3%. We need to see numbers like 4 or 5% consistently for a couple years to get the unemployment rate, you know, moving back down significantly.
So when do
Can I say, you know, I think this signals that it's very important for policymakers to remain very aggressive. I mean, the economy is out of recession. It is in recovery, but as we can see, it's a very fragile recovery. Business confidence, consumer confidence still very low. And I think it's very important for the Federal Reserve and fiscal policymakers to continue to provide a lot of support to the economy, because I don't think that we're there yet. We need that support. Otherwise, the economy will slide back into, if not recession, something pretty close.
Can they be, Scott, can they be aggressive enough? I mean, if you've got to make up with government spending what we've lost from consumer spending, is that doable?
Well, you know, the stimulus that we've seen so far has kind of helped offset a lot of the damage, but it really hasn't propelled the economy forward. A lot of that positive impact is being offset by the constraints that we're seeing on state and local budgets. We're seeing government payrolls down over the last 4 or 5 months. That's not a good sign. You know, there's a real danger, I think, of a double dip as the fiscal stimulus starts to ramp down later next year and into 2011. There may be a need for a second stimulus, but politically it's going to be very, very, very difficult to get that done.
All right, that's something we were talking about earlier with Jared Bernstein. We will continue to talk about that. Gentlemen, thanks so much for joining us. Mark Zandi there of Moody's economy.com and Scott Brown of Raymond James. We're going to